Well, hey, Neil, that's right. Jeffrey Lacker, the president of the Richmond Federal Reserve, is joining us now to talk the economy and economic policy, interest rates. Last month, he voted to raise rates at the policy meeting. He was outnumbered, however, as some of his colleagues were worried about developments overseas and said they wanted to wait on the data, wait on the numbers. He issued a dissent, his first one this year. Then in an interview on October 1st said depending on the data, the Fed could raise rates in October at its policy meeting at the end of this month. Well, President Lacker, let's look at welcome, and let's look at the data since then. And particularly today, we got a weaker than expected wholesale price report, weaker than expected retail sales. And when you gave that interview October 1st, it was the day before that weak jobs report came out. What is the data telling you now, and will the Fed raise rates at its meeting in 2 weeks?
Well, to cut to the chase, I don't know whether we're going to raise rates in October or not. I made a decision at the last meeting to dissent because I thought conditions warranted higher rates then. I thought the same was true back in June. I was persuaded to hold off, that the timing of an interest rate increase wouldn't matter, plus or minus 1 or 2 meetings. Beyond 2 meetings, getting up to 6, 9 months, that's another matter entirely. As for the data, so the retail sales report was maybe a notch lower than expectations, but I don't think it changes the outlook fundamentally. It doesn't change the picture for me much. Consumer spending's been very strong. We had some very strong retail sales numbers in the spring and the summer. People are looking at over 3% real consumer spending growth for the third quarter, and that's been consistent with consumer spendings having been very strong over the last 2 years, over 3% growth, in contrast to less than 2% early in the expansion. So that, for me, is an important data point, and it doesn't change my outlook that much. The jobs report is an interesting question. So a couple of numbers that start with 1 instead of 2, below 200,000 jobs per month. I'd point out, though, that even 100,000 jobs per month is more than enough to keep up with the growth of the working age population. We've been growing more rapidly than that as we've been driving the unemployment rate down. My assessment of the data is that it's unlikely there's any meaningful slack left in the labor market. And I think it's quite plausible that the slowdown in employment growth reflects an increasing difficulty some firms are having in finding qualified workers. In essence, that's getting harder and harder, and that's what's slowing down growth, not a big stall out in demand of any sort. So that's how I read the data, and I'll be putting this together with my staff and listening to my colleagues at the next meeting before I make a decision.
But based on the data that you've seen, it doesn't sound like your outlook has changed very much, and that you would be for pulling the trigger in October.
Well, I think the higher sustained growth we've seen in real consumer spending strongly suggests that real interest rates need to be higher than they are now. It seems unlikely that real interest rates where they are at below negative 1% inflation-adjusted interest rates is going to be sustainable with this stretch of consumer spending growth at this pace. I think slack is minimal at this point. I'm confident inflation is going to move back to 2% in the near term after these transitory shocks from declining oil prices and the rise in the dollar play out. That's what we saw earlier this year. We had the big decline in oil prices and dollar shock in January. After that was over, we got 2.5% inflation over the next 6 months, the way we like to measure it best. So I'm confident that kind of rebound inflation is plausible.
So it sounds like October will be okay. For you.
So again, I'll make a final decision on the way in, but my views haven't changed much since September.
And then, what about, though, some of your colleagues? We heard a couple of Fed governors yesterday and Monday, Governor Tarullo and Governor Brainerd. Governor Tarullo yesterday indicating that he doesn't want to raise rates until next year. He's not confident yet. Governor Brainerd is talking about developments overseas and saying that she's concerned about, still wants to wait to see if there's any impact of China and financial market instability, the high dollar, and whether or not that is going to hurt the U.S. economy. What do you have to say to them, and what do you think of what they said?
Well, I won't speak for my colleagues or characterize their views. You mentioned China, the volatility we saw over the summer. Obviously, from the FOMC statement and the minutes, people know that the volatility in financial markets here and the volatility abroad and the prospect of the potential for downside risks to global economic growth were present for us, and something we took on board and had an influence on the decision, I think. So I think there's been times in the past where we've overreacted to financial market volatility, particularly in a case like this where it seems like the volatility is unrelated to fundamental prospects for U.S. growth. There didn't seem to me to be a lot of information in equity market moves in August for growth prospects. There didn't seem to be a lot of news that would warrant revising down the U.S. outlook materially. So at times like that, it's tempting to pause for a while, but we've gotten into trouble in the past by pausing for too long. For example, '98, we cut rates 3 times in response to the turmoil over the summer. We were dilatory, taking it back. We got behind the curve in 1999.
Right. Unfortunately, we're out of time, but we'll look to see if there's another descent, possibly in October or maybe later on in the year. But Jeffrey Lacker of the Richmond Fed, thanks for joining us today on Fox Business. Neil, we're going to continue our conversation for a few more minutes and have that content posted exclusively to our website, foxbusiness.com, later today. So look for that material. Neil.
Fascinating. Thank you very much, Peter Barnes. All right.